Hi, my name is James, and today we'll be unpacking the Turkish economy and mainly focusing on the Turkish lira. Before we begin analysing the lira, let's first put it out there that the GDP growth rate within Turkey has been great, despite the fact the lira has depreciated so much. So to unpack the problems facing the Turkish lira, let's do a comparison of balance of payments between Turkey and China and understand why this has a huge effect on the currency. So the current account surplus is essentially when you export more than you import. In the case of China, they export a lot more than they import. And what this does is it requires foreign consumers to basically convert their foreign currency to the yuan. This puts upward pressure on the yuan. The other side of the equation is the financial account. The financial account tracks all the financial flows into a country, in this case China. As we can see, in the early 2000s, a ton of foreign direct investment came into China, and this required foreign investors converting their currency to the yuan. This put upward pressure on the yuan, but as currency or foreign direct investment leaves China, this caused investors to sell their currency for their own native currencies. Another part of the financial accounts equation is the change in reserve assets, this blue line, and as you can see, it basically offsets a ton of upward pressure on the Chinese yuan caused by the current account and the foreign direct investment flows. The Chinese central bank will then recycle US dollars and US treasuries and basically accumulate a ton of foreign assets, which can then be used in times of crisis like now to sell off and protect the yuan. The key idea is that the flows coming into a country, whether they be from the current account or the financial account, equal the flows going out. And this will mean that the currency does not appreciate or depreciate. You can change the value of the financial account by altering how much reserves you sell off or buy, but this has a limit based on how much reserves you actually have, which in the case of China is a ton. 3.3 trillion. So to solidify our understanding of the balance of payments, before we analyze the lira, you want to export more than you import to appreciate your currency. You also want to have net positive foreign direct investment, or you want to be selling off reserves to appreciate your currency. If you want to increase this, you need to raise interest rates. This will make your currency more attractive and people pour in. And also, if you want to appreciate your currency, you need to sell off your foreign assets. So we're taking our understanding of the Chinese balance of payments and apply it to the Turkish balance of payments. We can see that the Turkish economy runs a current account deficit, which basically means they import more than they export, which puts downward pressure on the lira. They also have a net negative international investment position, which basically means they have more liabilities or foreign liabilities abroad than they do have assets, which means if all the assets and liabilities were sold off, there would be a ton of downward pressure on the lira. And if we look at the actual financial account and what's financing the current account, we can see that a lot of the foreign direct investment and portfolio investment came in the early 2000s, but a lot of currency loans were also given out in this other investment. When this currency investment or other investment reversed, massive problems occurred in 2018. And we can see that after Turkey began raising interest rates, this put upward pressure on the lira because foreign direct investment came into Turkey, but after fears came that Erdogan was going to cut interest rates again, it all left. After the 2001 banking and currency crisis in Turkey, Turkey started an IMF program, reformed and recapitalized banks, and gave the CBRT more independence and shifted to inflation targeting. This resulted in stronger banks, falling inflation, as we can see here, and primary budget surpluses and high growth. So global investors looked at Turkey and basically saw an opportunity. The crisis is behind them, reforms are done, now there's a growth story. They began loaning a ton of foreign currency, which is this blue, and these foreign currency loans were used to prop up the lira and stabilize it in the early 2000s. The problem is that this was based on the fact that Turkey was going to join the EU and keep inflation under control. And the banking system inside Turkey decided to also not invest into manufacturing, which would have been great to grow its exports to get more foreign currency. The problem is they invested it all into construction or into funding the current account or imports, rather than actually long-term prosperity, such as manufacturing, so they can get more foreign currency exchange and repay these loans. The problem is that all this growth and the current account deficit was financed by borrowed foreign currency, and if investors ever lost confidence like they did in 2018 and demand repayment, the currency begins to collapse. So what actually caused the 2018 currency run? Well, as we spoke about, a lot of the confidence was based on the fact that Turkey was going to boost its exports and grow into its manufacturing powerhouse. But unfortunately in 2018, due to beef over Syria between Trump and President Erdogan, after President Erdogan had arrested US pastor Andrew Bronson, the White House then sanctioned Turkey and placed tariffs on Turkish steel and aluminium. And this killed Turkish exports and basically told international investors that Turkey was never going to get this foreign currency to repay their foreign currency loans. And this caused foreign investors to demand repayment of foreign currency loans all at once. And what this did was there was nothing to offset the current account deficit, so there's a ton of downward pressure on the lira, and the lira spiked. To stabilize the situation, the central bank used their foreign exchange reserves to counteract the selling. And what this did, it temporarily stabilized the lira, but eventually, because these reserves were borrowed to stabilize the lira, they had to be repaid back. When they had to be repaid, eventually there was nothing to stop the lira from skyrocketing, as we can see here. And what happened was sky-high inflation. And Erdogan actually fired the central banker who was going to defend the Turkish lira against inflation by raising interest rates, and then put a new central banker in who would cut interest rates into inflation. And this spooked markets, which you can see the portfolio investment sell-off as investors left Turkey and went to higher yields in the United States, who was raising interest rates. And due to the fact that the Turkish central bank cut interest rates into inflation, this caused an exodus of foreign exchange reserves, as foreign investors were worried that the Turkish central bank would use these reserves to pay off their own debts. This caused a foreign currency shortage right at the worst possible time, when all the citizens within Turkey were trying to convert their lira to foreign currency, and also all the businesses as well. So the Turkish central bank had to step in and come up with this program called the KKM. Basically, whatever losses the lira suffered on the foreign exchange market, they would compensate in your deposit account held at the banks. The problem is that this interest the central bank paid to all depositors in lira had to be printed up. So lira had to be printed up, which further devalued the exchange rate and basically accumulated a ton of losses. These KKM losses that you see here basically require the central bank to print out money and pay for all these obligations. The problem is that these were so enormous that even despite the Turkish central bank raising interest rates to 50%, the Turkish lira still lost a ton of value. So how do you stabilize the lira? Well, it's quite easy. You raise interest rates, which will get you more portfolio investment, as we see here, and don't lower them, but instead take this capital that comes in and invest it into your manufacturing and export industry so you can get foreign currency exchange, and this will improve your NIP position. But this is unlikely to happen because Turkey or Erdogan is likely to cut interest rates back down, as he doesn't believe in interest rates, and there is zero independence for the Turkish central bank. So the options market is pricing the Turkish lira to depreciate markedly over the next 3 years, and it'll be terrible for importers because the cost of imports will go up. This will cause more inflation and just more of the same.